Thank you, Matt. Not so much someone who doesn't need introduction, but probably someone who you wouldn't want to introduce anyone else to. Big issues and trends that we still see: continued uncertainty in the United States and Europe. Europe's effectively in recession, and we'd probably expect that to stay there for the next year or two. And Barry will probably talk about some of the implications of that. My view is that the US economy is probably due for a significant rebound in 2013. One of the points we put up there is this uncertainty about the fiscal cliff, where their budget could well extract about 4 to 5% of total output in the first half of 2013. That could actually have a bit of an impact. One of the things that I think probably strategically is going to be important in the United States is that in 4 to 5 years' time they could in fact be independent of the rest of the world on energy. That'll have an interesting issue strategically for the relationships with China and the Middle East. We can talk about that in a bit more detail a bit later. There's also lots of stories now that a lot of manufacturing plants are looking to shift back to the United States because of their very low wages growth, strong productivity gains, and very strong wages growth in China, which is good for the Chinese, but as I said, and I think their housing sector's due for recovery. Got the rise of the emerging economies. In my view, that's going to keep the Australian dollar high, as you've probably heard me say over the last several years. Structural change accelerating in Australia and South Australia for some of those reasons we've put up there. You know, the world is changing, and Barry, again, I'm sure we'll talk about some of the issues, what that means for research, education, the way we should look at the world, an ageing population. Governments really have spent the mining boom before it arrived, and I think we saw an indication of that yesterday when they announced that the mining tax for the first quarter has not returned $1. We've actually already spent that money. And then South Australian government issues which are going to affect us. And these are some of the types of things we're going to be talking about in more detail sort of over the next 12 months. And if you visit our website, you can sort of see some of it there. The chart from the International Monetary Fund again shows the divergence of growth. The United States perhaps growing no more than 2% in 2013, although in fact I think now it will do better than that. Japan, Europe really not growing at all. Then we have China, India, even with all their problems, still growing at the 6 to 8%. And Indonesia, and again, I think Indonesia is one of those countries that we actually don't think enough about in terms of our opportunities. You might have seen the Australian Agricultural Company is now building an abattoir in Darwin to service the Indonesian market. That cattle used to come this way, so we're going to have to think about where we sit with that. But again, the growth rates there, this continued great divergence, and that's driving what's happening in Australia. US companies. You might have seen some concern about the earnings reports that are coming out. The interesting thing there is that their profits are still growing, and their profits are at record levels, and so are their cash flows. And again, this is going to give the capacity when a bit of confidence returns for a significant increase in business investment, and I'd say particularly in the mining sector. Their mining sector continues to grow, in fact much faster than ours. Recent report, there are now more people employed in the mining and gas sector than there is in the US car industry. That's the change around that's happened. And their gas prices are now a third of what they are in Europe or Japan, and those gas prices are no higher than they were in 1995. This is having a significant impact on their manufacturing sector, and their actual carbon emissions are falling as they're switching to gas away from coal. China. Everyone's worried about it slowing down. We're starting to hear more talk now about it speeding up again. The leading economic indicators there, which are the red lines, sort of show that on most measures, China will continue to grow at 7 to 8% for the foreseeable future. And again, good news, I think, for Australia. Our view that we put a couple of months ago was that when iron ore prices fell to $90 a tonne, that was far too low. Back at $120 a tonne. Interesting thing is there's a lot of focus on iron ore and coal. If you have a look at copper prices, they are still 4 to 5 times what they were 5 years ago. And same with iron ore. Iron ore at $120 a tonne is 6 times what it was back in 2004. The problem that Australia faces, I think, with the mining boom is that we've actually priced ourselves out of the markets rather than it being a result of a significant fall in the commodities prices. Those other sectors, and I think this again where rapid sort of change is occurring in our economy as a result of these growing middle classes. And as I said, Barry is likely to talk about this stuff too. Food's a particularly important area. And one of the things that surprised me, and there may hopefully be some people in the market here who are in the wine industry, is the way the Chinese are taking to red wine. I just find that really quite surprising. But it's great that they're doing it. Travel. One of the things we're going to have to get used to is that we are going to be seeing a lot more tourists here, and we can't speak their language and they can't speak ours. So what are we going to do about speaking their language to help them here? Leslie Lynn down here, one of our clients, I think probably has some significant views on that. But my view would be encourage your kids to learn Mandarin. Why do I think the Australian dollar is going to stay high? This is our usual chart, which we keep updating. The red line is commodity prices in US dollars from a group in the United States called the Commodity Research Bureau. They put out this index every day. I take those numbers, has nothing to do with Australia. The blue line is the wholesale price index in the United States in US dollars. Again, these two things are both in US dollars. They're not put together in Australia. So what I do is I divide the red line by the blue line. That gives me the red line on that chart, and the blue line is the Australian dollar US dollar exchange rate. So whatever you did in Economics 1, and I won't talk about our esteemed leader, what has happened there is you can sort of see how our currency is really outside our control. And we just have to get used to the idea that it's going to continue to be driven by what happens to commodities prices and adjust to it. Because in my view, with what's happening in China and India, as you've probably heard me say before, commodity prices are likely to remain high. We just need to get used to the idea the Australian dollar will remain at parity or above. Australian companies, we've had a bit of a dip in profits over the last couple of quarters, but still remain at very high levels. In fact, our profits continue to be at the highest proportion of total output that we've seen for decades. So companies have got the money, they've got the cash, it's just the uncertainty about where they're going to spend it. Australian economy, and these were the forecasts coming out of the mid-year economic and fiscal review. There's some real sleepers in that stuff, which I said we'll be talking about over the next couple of months. One of the big ones, the government expects to raise $555 million to help with the deficit by taking unclaimed deposits and superannuation faster. So if you've got any out there, make sure you go and claim it yourself. But again, the divergence in the Australian economy. Consumption, pretty flat. If you're in retail, particularly traditional retail, it's going to stay tough. The government is expecting the housing sector to start picking up more strongly, so they've doubled the growth rate for housing. But that would still only imply about 140,000 housing starts, which again would suggest we're underbuilding. So those of you baby boomers who've got kids and they're still staying at home, they're not moving out for quite a while yet. Again, get used to that. Business investment, really still the strongest part of the economy, but very much focused on the mining sector. And again, significant issues for South Australia as to how we deal with the sort of the disappointment about BHP. But in fact, my view is get over it, because there's plenty of other mines out there. And some of those mines, while they might be not the size of Olympic Dam, are very big in their own right. And some of you who've got holiday homes at Ardrossan are probably seeing what's going on over there at the moment. Could well end up being one of Australia's bigger copper mines. The Australian economy, inflation to remain low. This is going to keep interest rates relatively low. So inflation around 2 to 3%. In fact, could be a bit lower. The big sleeper, if you've got a big fridge, is to actually start buying beef now, because beef prices are going to rise significantly the new year because of the downturn in US beef production because of their drought. I'll just finish off on this one because we're running out of time. The interest rates, what this black line shows, and this is sort of encapsulates what's been happening in the finance sector over the last 5 years. The black line shows the Commonwealth Government bond rate for 3 years. And as you can see, that has got down to the lowest levels we have ever seen in Australia. These are even lower at 2% than we saw during the Great Depression. The red line is the cost of funding to banks, what we call the swap rate. And you can see how that's moved on this chart over time as confidence has ebbed and flowed. So when the confidence in the banking system is very low, the bond rates fall, but the swap rates don't come down as much. So the spread moves out. The black stars and the red stars represent the term deposit rates and home loan interest rates. What is happening is that the banks are reducing their need for funding, and I think for the clients who've got term deposits, they're going to be rather disappointed over the next 12 months because the term deposit rates, I believe, are going to be coming down quite quickly. So people who are dependent upon interest from term deposits may well be finding that income is going to be falling. And so I think they're going to have to be either getting used to the idea of actually consuming capital, which is what is happening in the United States. How would you like to be a retiree in the United States where the interest rates are effectively zero? Now, we're not moving towards that yet, but this chart here, and I said we'll be doing some sort of video stuff on it later. If you want to visit our website, we'll be explaining some of the implications. But what it is showing is that the banks have actually come through the crisis in a much better state than we probably even expected 12 months ago. They are starting to reduce their need for funding, and my view is they're going to become less competitive on term deposit rates. The other side of it is they're looking for new business lending opportunities. Their issue is actually getting over their credit issues, self-imposed. There's some stuff just on South Australia. I think we're actually in for a pretty tough year. Retail spending, that's in nominal terms remaining quite low. And again, if you're in business, some charts we can sort of show the divergence. If you're in newspapers and magazines, year-on-year growth is something in the order of minus 30%. If you're in cafes, restaurants, you're up about 20%. There is a huge divergence going on. Well, thank you. I hope you enjoy your lunch. And as I said, if there are any questions or other issues you'd like to raise with that, talk to our advisors or give us a call. And we can go through this in a bit more detail. But in the interest of time and listening to Barry, who's getting his lunch down, thank you.